Let me ask you something. Have you ever seen a breakout and the stock moves 10, 15, even 50% up and you just watch the stock go up, or even worse, you catch it and then you get a failed breakout and lose a ton of money? You're not alone. This used to happen to me literally all the time until I learned how to actually implement volume into my strategy and to accurately have a confirmation on breakouts. And not just by looking if the volume is high or low, really understanding how to read it and look for specific patterns in the volume. Just like stocks and charts have patterns, volume is going to have pattern as well, and it's going to tell you the story of what is happening underneath the stock. Today, I'm breaking down the 3 things that changed literally everything for me as a trader and made me the trader that I am today. The first thing is volume analysis, how I read volume and actually understand what's happening underneath the stock to be able to catch the strongest moves within the market. The second thing is breakout setups. This is going to be setups that I use to catch momentum that can literally make me 10K and even spiral all the way to making me 6 figures in profits on just one trade, because you're catching momentum with exponential leverage. And number 3 is combining this with my exact swing trading strategy that I use to catch the strongest trades within the market and actually hold them until they hit their profits and their targets, versus just selling too early and only catching a small move. And I'm not just saying this for YouTube. These are literally the exact strategies and the exact methodology that got me from almost quitting options about 4 years ago to now consistently making almost 6 figures every single month trading. So if you're still chasing random plays, if you're still getting chopped out, and if you don't know which stocks to trade, this is going to be the video for you to help you find these stocks and actually understand how to read volume and find these key things within the stock that are going to make for insane trades. All right, so the first thing we have to talk about is the volume. A lot of people will just look at volume and then just look to see if it's high or low to decide if they want to buy the stock or the option that they're looking to trade. But nobody seems to actually correctly understand how to use volume and use patterns within volume to actually find the things that are happening under the hood of the stock. This is what I look for before I even touch a breakout. This is called a strong volume pattern, and it's usually a sign of accumulation within the markets. So how this looks like is a stock will make either a big move up or a big move down, and that move will be accompanied by a ton of volume. So right here, you could see this stock makes a big move up. Then there's a ton of volume on this move up as the stock is going up. Now, when the stock goes sideways and when it's setting up for a continuation move, what you want to see is lower volume as the stock goes sideways. If the volume is high as the stock is setting up, or if it's getting sold off and the stock goes lower, now you know institutions and big players are selling out of their position versus looking to get back in at the average price. Low volume pullbacks basically tell us that institutions are not selling out of their position, because if they were to sell, you would see it set up in the volume patterns. For example, you could see super high volume as they buy and then almost no volume as they sell, indicating to you that there's not a lot of institutional selling. Now, as the stock is breaking out again, what you want to see is high volume as the stock is breaking out and getting through the key level that it's breaking. So for example, right here, you could see the exact volume pattern play out. You have high volume as the stock goes up, and you have low volume consolidation as the stock goes sideways, and then high volume as the stock goes up again. And you could actually see this doesn't only happen just once. You have high volume again as the stock goes up, low volume, so it's declining as the stock consolidates, and then again you have high volume as the stock goes up and confirms the breakout. This is going to be the type of volume patterns you want to look for when you're looking for continuation and when you're looking for the strongest volume patterns within the market. Now, this is the difference between strong volume patterns and weak volume patterns like this. For this pattern, you could see the stock was actually going up on very low volume. It was below average and there wasn't really a lot of volume as it was going up. And there was actually a lot of selling volume that was happening off the high. So right here we had some sell volume, right here we had some sell volume. And then when it broke the high and broke out of the base, you could see volume was extremely low. It wasn't high like we saw in the other example. It was very low and below the average cloud right here. And then from there, you could see the volume actually picked up to the sell side and sellers were able to step in and really take this lower below this level right here. And this probably happens to you a lot when you're trading breakouts. This is called a failed breakout, and a lot of times it's because the volume is not supporting buyers. There's just not a lot of demand for the stock or the asset to continue to go up. So what happens is sellers take over and then they come in with a ton of volume and they bring price lower, basically trapping buyers up here. And a lot of times you're the one that's going to be trapped if you don't look for the correct volume patterns. A great tool that I use to see if the volume is above average on any stock that I'm looking at is the volume MA. So you can actually head over here to where it says volume on TradingView, and then you can click on style and turn on the volume MA, go to area and click the cloud. What this is going to do is this is going to be a tool to basically show you when volume is above average. So whenever the volume is above the cloud, it's actually above average. So you could see what we usually want to see for a breakout is the volume to be above the cloud. But right here for this example, you could see it was below, and then the selling was actually above, which indicated to us that there was a lot of selling pressure. So usually a strong, healthy breakout will look something like this. And this is actually why you could see this breakout ended up getting sustained and then moving higher, because the volume was very high on it. Now, here's another example, right? The stock goes up, then it goes sideways on low volume, and then high volume as it breaks up above the cloud, indicating strength. And you could see the pullbacks are on much lower volume as the stock is going sideways, low volume, and then again, high volume as it continues up. These are the types of volume patterns you need to look for in all your setups. If your setup doesn't look like this and the volume patterns don't look like this, there's a good chance you're not going to get a lot of follow through. The best setups in the market will set up like this because it shows you that institutions are accumulating the stock. Again, remember, when institutions buy, it takes a good amount of time. So they're not going to all buy at one shot, but when they do buy, it shows in the volume. There's a lot of shares that are being bought. That is why it's going to show in the volume. And then that's why you want to see lower volume as the stock consolidates, basically indicating to you that institutions didn't sell and then that they buy back again after price hits either the moving averages or a key support level, and then look for the continuation higher, which is what we saw here. Another way to use volume is to read accumulation versus distribution in the market. So what accumulation is basically when institutions and big money are accumulating a position. This usually happens after a stock is very extended from a big move to the downside. What will happen is weak hands or retail here will start capitulating and smart money will start buying because they're obviously buying cheaper than where retail bought, which is probably all the way up here. And then the money switches hands over from the impatient to the patient. Now, what you'll usually see happen during an accumulation phase is you'll see a ton of volume on the left side of the base. And you could see here the stock will have a lot of volume into the lows. The reason why this happens is something called capitulation. Capitulation is when retail traders or just traders in general are just sick and tired of holding the position. They think it's never going to come back. And this is usually the lowest price the stock will go when everyone just sells out of their position, just full panic and despair mode. This is usually marking the bottom of the stock. And you'll see this when it comes with a lot of volume. The reason why this happens is there's a ton of selling that happens. It's called a selling climax. And then institutions are all absorbing that selling and buying into that position. Usually this will be marked by some sort of hammer or bullish candle. For example, right here, you could see we had a hammer candle. And then what will happen is the volume will begin to decline. Throughout the base, you'll start seeing that institutions are going to start accumulating again. So right now I'm on the weekly time frame, and what you could notice in this space is as the stock continues to get bought up, all the green candles are actually on super high volume, whereas the red candles are almost on no volume. So you could see we had one time right here where there was an anomaly, but other than that, every single candle that was above average, for example here were all green candles. What does this indicate to you? Well, it indicates to you that institutions are accumulating a position, and what's likely to happen is the stock is likely to start running back up. Now, knowing accumulation, we can actually understand when the best times to enter the markets are. Whenever the stock is being accumulated and it starts to break out of its accumulation base, for example, right here is actually the best time to trade it, or even when it gets through the highs of the base right here, you can look to take the continuation play, especially when you see a ton of volume. But the most important thing is the breakout needs to happen on high volume. You could see when the stock sets up right here, a ton of volume as it breaks out, then it sets up again, a ton of volume as it breaks out and makes that big move up. You always want a lot of volume when the stock is breaking out. Now, we just talked about accumulation. Now we're going to talk about distribution. So distribution is basically the opposite of accumulation when institutions start to distribute their shares. Now, again, remember, these processes do take a long period of time. It's not going to all happen in one day. So what I like to use is the weekly or daily timeframes to kind of get an understanding of where all the selling volume is coming. So for example, on this stock right here, SMH, you could see we had a ton of sell volume on the left side of the base, right? Indicating to you that buyers are starting to get super greedy and euphoric. And then this is where the institutions start taking profits while retail kind of buys all the way into the high. So the same kind of concept, just the other way. Then you have a big move down that occurs, which is the first leg down, and then retail will think this is the bottom, and then we end up getting a ton of sell volume basically at every single pop. You could see it gets sold off on high volume. Now, obviously, there's a few times where you have high volume to the upside, but most of the anomalies come from the sell side, especially as the stock is going down. You could see super high volume on the sell side. The highest volume is always going to be from the sell side, indicating distribution, and that will obviously help you get into a potential downside position as the stock is moving down. So when it's breaking down out of the base, you can look to buy puts and then play the breakout to the downside. Now, this is a super important concept to learn because you can catch things when they're actually starting to bottom without having to guess that a bottom is going to happen and waiting for the base to occur. So this is what I like to do. I like to wait for the base to set up and see if accumulation is present during the base. So for example, you could see the ticker Tesla here is on a big downside move. Then it gets a capitulation candle right here, a ton of volume on the left side, and then volume will start declining as the stock is going sideways. But then you start to notice there's actually high volume as the stock goes up. And then when it goes down, the volume is pretty low. And then the volume is super high as the stock starts to go back up again, low volume as it goes down, and high volume as it goes up. Low volume as it goes sideways, high volume as it goes up. So the volume patterns are starting to change and tell us that, okay, a bottom is in place and we could start buying it as it's breaking out of the base, specifically on very high volume. So now that you got volume, what is the actual setup to trade? Well, what you want to trade is tight bases and tight continuation patterns. You always want the stock to be tight no matter what. Tightness equals expansion within the market. Whenever you get compression, that is when the next leg up happens within the markets. So here are about 4 examples of setups that I use when looking at a chart. And the setups that I use just need to be a big base on the daily time frame. No matter what, I always need to find a big base on the big time frame. So I always want to use the bigger time frames for my setup. The bigger the time frame, the better. So for example, you could see on this ticker right here, Tesla, it sets up in a big base right here. It's rejecting at the highs multiple times. The moment it starts to break out of this right side of the flag, you could see the volume patterns are confirming to us that the stock is going to go up. So there's high volume as the stock goes up. It goes sideways with very low volume, and then a ton of volume comes in as it starts to break out. So you could buy it right here as it's breaking out. You could see it gaps up, makes a huge move to the upside. Now, we never want to buy the stock when it's extended away from the moving averages. So we always want to put the moving averages on. And this is exactly what we talked about in the last video. You always want to buy into the moving averages on a strong move up. So for example, right here, you can see the stock gets extended. We never want to buy an extension from the moving averages or chase a stock. We want to wait for it to set back up into the moving averages. So notice what happens here. The volume is very high as the stock is going up. And then what happens is the volume will actually decrease as the stock consolidates. What does that tell us? Well, that tells us that institutions are not selling out of their position. And there's a good chance that as volume inclines, you're going to get a continuation up. So there's a setup here you could trade. You could play the breakout of this move right here. If you're not able to catch this, you can wait for the stock to set back up again. Again, remember, the most important thing is that there's low volume as the stock is setting up. So low volume as the stock sets up. So you could see right here, it goes sideways, sets up, low volume, and then boom, as it breaks out, you can see the volume starts to increase again, showing you that buyers are interested and there's probably going to be a big breakout that is going to occur. These are the exact volume patterns you need to look for breakouts. If you don't look for these volume patterns, what's going to happen is you're going to get faked out like those examples that I was showing. Here's another perfect example. This is a trade that I recently took on the ticker Tesla again. So set up very similarly to the other setup that we saw. And this is why patterns are so lucrative, because all you're seeing in the patterns is human emotions, and human emotions are never going to change. Patterns are always going to remain the same in the markets. There's traders that have been trading 50 years to 100 years ago, and they say that the patterns are always the same because it's human emotions. Patterns are always human emotions. And if you don't believe in patterns, I really suggest to study the market, because the markets are always setting up in patterns and there's always similar patterns that occur. And if you could take advantage of these patterns, not only stock patterns, but volume patterns, you can make a ton of money. So this stock right here was setting up in a massive base. This could be your first entry right here as it's breaking out. It's also set up in a tight flag right here. And again, you could see as the stock goes up, volume is high, low volume consolidation, super low until it gets to this point right here where it's just almost non-existent. And then as the stock goes up again, ton of volume as the stock goes up. This is why volume patterns are so important, and using volume can really give you an idea of how a stock is going to continue to move and if there's a lot of fuel for the stock to go up. Always think about the volume as fuel. A stock can't go up on low volume because there's not enough fuel for it to continue to go higher. Volume shows us the interest for buyers and sellers and shows us the aggression. If sellers are very aggressive, if buyers are very aggressive, the volume is going to show that. Now, here's where it gets super fun. So I don't just scalp, I don't just take small day trades, I swing trade and I catch absolutely huge moves within the market. And in my opinion, this is the best way to trade. If you swing trade momentum within the market, you can catch absolutely massive winners because big moves happen over a large period of time. Think about it. The biggest moves will take months, weeks to play out. And if you're not catching those big moves, you have to be right every single day, really day trading, right? But a few positions with swing trading can make your whole year if you catch the big winners within the market and you catch the leading themes that we talked about in the first episode of Back to Basics. Here's an example of one of the best swing trades that I've ever taken in my life. This was on the setup SMCI. Now I want to go through the checklist that I use to find these setups and identify them and make sure that they're A+ before I take the entry. So first of all, you can identify right away that this stock was setting up in an absolutely massive base. We had a huge daily base right here that was setting up for the past few months. It was setting up beautifully. It wasn't making new lows. It wasn't making new highs. That's exactly what you want to see in a base. Now, this stock, SMCI, was in a super strong sector. It was the AI sector, and it was in a narrative in the theme that was super strong. This is when AI was super strong. It was coming into the markets with a buzz. Everyone was chasing AI stocks, the next stock, hardware stocks. This is a semiconductor stock that makes the chips for data centers. So it was a super hot stock. It had a theme behind it. It had momentum, and it was in a clean uptrend. That's something that's super important. You want it to be above the moving averages as it's making its move up. You don't want a stock to be below the moving averages like so. This is going to make for choppy price action. You could see the stock really only starts to get moving once it gets above the moving averages, holds the moving averages, and then starts to trend. That's where the big move actually happens. Now, the next thing is you need a tight pattern and a big base. So the first thing you see here is an absolutely massive base was setting up. And then it was setting up in that super tight pattern that we look for. This is kind of like a bull flag here, right into the moving averages, held perfectly, and then it broke out. And then the best part is you could see it was consolidating on very low volume. So exactly what we talked about earlier in the video. As the stock went up, you had very high volume as it broke out, but very low volume as the stock set up. So high volume as it went up the first leg, then low volume setup, and then high volume as it breaks out, really indicating a lot of strength from buyers. The most important thing is I'm never trading 0 DTEs on these. These are going to be swings. So I'm taking about 2 to 3 weeks out, sometimes a month or two out, depending on the size of the base. But the moment I take the trade, I look to hold for a long period of time. And what I'm doing is targeting big key levels. So if the stock's at $35, I'm looking to target $40. I'm looking to target $50. I'm looking for exponential moves on setups like this because they're just going to continue to run. If the stock has that checklist and it's in a super strong theme, the markets are strong. You can see the stock ended up running all the way to 107. I caught it all the way to about 84 bucks, not all the way until the high, but still caught an absolutely amazing trade on this one, all the way from $35 to almost $84 with options, which was an insane return for this trade. And the setup was absolutely phenomenal. These are the types of setups that I look for within the market. Here's another similar setup that I took. This was on the ticker AMD. Same kind of idea. I want to really ingrain the setup into your guys' head because it works so well. So you have a big base that sets up. The stock will move up on a ton of volume. As the base gets set up, volume will decline. That's the most important part. Volume needs to be lower as the stock consolidates. Then you could see volume starts to come back up. You have the big move up into this base right here. It sets up the base. You have the highs to trade against, and then lower volume again as it sets up in that tight flag into the moving averages. So you could see the stock is above the key moving averages right here. It went up on super high volume, then it went down on low volume, and then boom, high volume again as the stock breaks out. You buy it as it's breaking this level right here. Your stop loss loss can go to the low of the day, and then you look to target key levels of resistance. You could use Fibonacci's for this. Target the fib levels 190, 198.27, or if there's previous price levels, you can always target the previous price levels as well. Here's another great example of a recent trade that I took. This was on the ticker Roblox. So you could see the stock's in a very strong theme. The software theme has been super strong over the last few weeks. It's been leading the markets higher. It's been above all the moving averages in a strong trend, and it built out a absolutely massive weekly base. So you could see you have a huge weekly base right here, retested the base, and then set up for an absolutely big continuation move. Now the daily time frame sets back up again. So on the daily time frame, you can see the stock goes up, then it starts to wait for the moving averages to catch up. You never want to buy when it's extended. It sets up beautifully. You wait for that setup to happen. You buy right as it's breaking the high, and then you get that big continuation to the upside. Stop loss goes to the low of day, and you can see the volume patterns, which are the most important part, are always going to be matching. The volume patterns are going to be high as the stock is going up, low volume as the stock is consolidating, and again, high volume the first time the stock goes up. That's how the patterns should look like. You want to be able to get to the point where you could literally look at the volume patterns and already understand what the stock is doing. So for example, right here, you could see the volume fades a lot, but then you have accumulation volume that is taking place, no high selling volume, and then boom, out of nowhere, you have a ton of volume. What do you think is happening here? The stock is likely breaking out and making an absolutely huge move up. And the reason why we know that is because accumulation was taking place. So you can sometimes see how just using the volume patterns, you can get such a good read on what the markets are doing and how a stock is moving. So right here is what the stock was doing. You see it set up in a huge base. You had capitulation volume on the left side of the chart. Then it was setting up. Accumulation started to take place. The stock started to go absolutely crazy. A ton of volume as it's moving up. And that is conviction. You could see it has high volume off the lows here. As the stock goes sideways, it has low volume. And then as it starts to break out and get through the moving averages, volume is super, super high, and you have confirmation of super strong volume. And even something like this, now you should have a good understanding of what the stock is doing here, right? When you start noticing something like this, what does this tell you? Remember what we talked about? Distribution. There's distribution within the markets. You could see as the stock is consolidating, the volume is low, but then boom, ton of volume again as it probably goes down, because you could see the volume patterns, right? They tell you the story until you start seeing it start to flip a little bit. But right here, you should already know what the stock is doing. And even going back here, you should know what the stock is doing. It looks very strong here. A lot of accumulation is going on. And going back to the stock, you could see that was exactly what happened. The stock was making a big move up here. And then this is when it started to go down. And you could see the volume patterns told us that whole story. So even when we're looking to take things to the downside, the volume pattern should tell us the story. So the first move down should happen on a lot of volume. You should have low volume as the stock goes up. And then you should have a ton of volume again as the stock continues to go lower. The whole point is you're using volume to validate the trend and really give you a good understanding of the power of the trend, how much momentum there actually is within the markets. And here's the best part about this strategy. You can literally find all these bases, set your alerts for the day, go to the gym, enjoy your time. And when the setup triggers, that is when you can enter the trade. You don't have to be sitting on the charts all day. And this is why I absolutely love swing trading. It's basically just freedom. The reason why I think swing trading is so much better than day trading is because you can catch these absolutely massive moves. For example, right here, you have to literally be right every single day to catch this move up. You have to trade the stock every single day and be right about it every single day. Whereas you could have just entered once on the break of the high. You would have been able to swing this all the way up and catch it on an absolutely massive move instead of having to be right every single day and catching exponential gains. This is something you can't do with day trading. A lot of money could be made with day trading quickly, but you can't have exponential returns because as the stocks start to get exponential with their movements up, you're not going to be able to catch them every single day. And if you're in a position, you're going to be able to let that position ride and collect exponential returns for you. So think about swing trading as basically less work, but more results, right? You're working smarter and you're letting the positions actually work instead of working harder and making less money. If you got value from this, make sure to hit the like and subscribe button and comment down below any of your favorite setups or whatever you want to see new videos on. And in the next and final episode of the Back to Basics series, I'm going to go over the most important part of trading. It's the execution part, having the discipline and risk management to be able to execute the correct way, having a trade plan and actually being able to follow that plan. This is where it will all change for you as a trader. Yes, a solid fundamental understanding of charting and technical analysis is super important, and you want to have the right foundation for success, but you want to be able to execute the correct way. I'm going to show you exactly how to overcome FOMO, revenge trading, over leveraging, and making stupid mistakes that you know you shouldn't be making anymore, and the personal systems that I use to stay calm, confident, and in control in my trading. And honestly, it might be the only video on risk management and psychology that you're ever going to need to watch. No fluff, no theory, just what actually works from years of experience. And I'll see you guys in the next one.